there, this is James, and you're watching Tixee Live. And a very good afternoon to all of you, and all of you a very happy Tuesday. In today's program, I want to chat a little bit about how the market currently, in general, is in the green and is licking its wounds after several devastating days in the market. Plus, I want to answer a question left to me in the comment section on my previous video I did this morning in reference to the US dollar and something which I think could become a very serious situation in the UK. But before we get into all of that, don't forget these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. With that out the way, let's get started. So I'm calling this little video Green Tuesday or Recovery Tuesday, because let's face it, Friday and Monday in particular have been absolutely devastating for the market. Absolutely devastating for the market. And today, like I said this morning, for the time being, the market has caught its breath back a little bit. The sterling, who was in all the headlines yesterday and all the headlines on Friday, dominated the market's mind, is managed to recovered slightly, and is clinging on to its current daily gains. Okay, the S&P 500 has also rebounded off yesterday's new 2022 low. In fact, yesterday it crashed to a new 2022 low, and that is also recovered. Oil has rebounded off a 9-month low. However, that's not necessarily due to risk appetite. It's actually due to concerns now for two reasons. Concerns that Hurricane Ian will reflect supply, because it's actually around the coast of Cuba, Florida, and obviously the Gulf of Mexico, which has quite a fair bit of oil, not oil inventories, what they're called, not pipelines, oil refineries, the ones in the sea, oil rigs. That was the word I was trying to remember, oil rigs. So that's why oil has rebounded. But in general, like I say, the market has had a little bit, and only really a taster of risk appetite. Let's have a quick look at the market before we talk about a couple of other things which I want to talk about. Let's start off with the sterling. Like I mentioned earlier on, it's just really just holding on to its gains. Yesterday, I mean, what a range. It ranged in between, from the low below the 104 handle to just, teasing to the 109 handle. So incredible volatility yesterday for the sterling. As it stands at the moment, as you can see, for the day, is currently in the green. That's why I'm calling it Green Tuesday. But as you can really see, it's been pretty much range bound. It's currently trading at 1.0767. Between those two key areas, in my opinion, 1.0870 as a potential resistance and a key potential support, 1.06939. Like I say, I've got a question about the US dollar, which was left in the comment section in this morning's video, which I would like to talk about. It's in the green. The euro is pretty much, if we look at on the day as well, also in the green today, after this suffering 4 days of constant losses. Again, pretty range bound at the moment. Current trading is 0.9616. Obviously, we've had more developments about the Nord Stream pipeline. That hasn't necessarily really affected it at the moment, because I think we're already coming to terms with the fact that Europe is going to get no more gas from Russia this winter. S&P 500, which is always the indicator for risk appetite. If we look on the day, again, it is in the green. It is ended. It was on a 5-day losing streak. And like I mentioned earlier on, it did touch a new 2022 low yesterday. It's now off that low, currently trading at 3,600 89 points. Nasdaq is in a similar situation as well. Okay, currently trading at 11,390 points. That suffered a 4-day low, so not as dramatic as the S&P 500, but still trying to make a recovery. Gold is pretty much the same as well. Small, tiny recovery again, because like I said, the dollar for the moment is having a break. Okay, like I said, he's still got his feet up, having a cup of tea. Currently trading at $1,635. That key area for me, for it to really start getting the bullish momentum again, still remains at $1,667. Bitcoin is probably showing most bullish nature. Again, it actually was quite bullish yesterday. Closed in gains, testing that key level, in my opinion, of $20,355. Like I say, though we have a spoonful of risk appetite on the market, only a spoonful, I do think there's other reasons why Bitcoin might be of interest to the market, and I'll talk a bit more about that in other videos. But yeah, if we have a quick look at oil, because we mentioned oil as well, like I say, off a 9-month low, still trading under $80 a barrel, but currently trading at $78.90. Like I say, this is generally down to the concerns of Ian hurricane affecting supply. So this is what's sort of, pushing up oil prices at the moment. Now, I want to talk about something else. Okay, there's two things. Like I said, one, I want to answer the question which was left in the comment section. The other was two things which I want to discuss. And those of you who know me or watch my videos, they know I take a keen interest in the housing market, because I think the housing market is a major factor in a country's economy. And at a time of high inflation and raising interest rates, it comes under the microscope a bit more. Now, instead of the US today, and I will talk about the US because there's some data from the US as well, which helps me answer the question the gentleman left me. But I want to talk about the UK housing market, because again, I think this is another worrying situation waiting to erupt in the UK. And the reason why I say this is that after yesterday's complete carnage of the sterling and the fear of increasing interest rates, a number of mortgage lenders halted mortgage offers, into this UK mortgage lenders, halted mortgage offers to new customers. Okay, these included the likes of Virgin Money, Skipton Bank, and Skipton Building Society, and Bank of Ireland, to name just a few. The reason why they withheld it is because some of these offers are obviously quite good offers, like long-term fixed rates. Okay, they're withdrawing them because if higher interest rates does happen, then those deals, then obviously we've got customers rushing to get better deals because they're on existing deals. Then obviously the bank's going to have to pay for them because of the high, or take the cost because of the higher interest rate, which is about to happen from the Bank of England at some point. So this is a worrying sign that they're actually, a number of mortgage lenders are worrying about this and worrying about remortgages as well as new homes, and being stuck, so to speak, for lack of a better word, with the bill. Okay, so that is a concern. That is a concern. In fact, 8.3 million people have mortgages in the UK, and it's estimated that 300,000 homeowners in the UK are coming to the end of their fixed rate mortgages. So basically what that means, when their mortgage term comes to an end, they then have to face the reality of higher interest rates. And this is the reason why a number of banks are removing these offers, is so that they can't remortgage into, again, another fixed rate, which will possibly protect them from the higher interest rates, which is bound to be coming in. Now, just to give you an example, okay, of what this means, and again, I've spoken about this in the US market, and I'm going to talk about the US market in a minute. Based on a 2-year fixed mortgage in the UK, when it ends, on average, monthly payments will rise from 863 British pounds to 1,490 British pounds. And don't forget, interest rates in the UK is only at 9.5% at the moment. Okay, and they want it to go, so 9.25% at the moment. They want it to go even higher. So this is really worrying, because the housing market in the UK, like the US, like in Canada, are major sectors. So again, I think the market's not talking so much about this at the moment. But I do think down the line, this will become major. This is another problem for the UK. Like I said, I'm still very bearish on the sterling. I still see it going to parity, which is not going to help. Inflation, like they've already said, is still going to remain around 10% for the next couple of, around the 10% range. Economic slowdown. So it's not a pretty picture for the UK at all. Which brings me on to one of my favorite analysts, who's also a bear like me at the moment, Mr. Mike Wilson of Morgan Stanley. He says a couple of interesting points. And this leads to the question this gentleman asked me in the comment section on YouTube. He said, the US dollar is at a point now that it is causing real stress. What he means by that is because if you have a very strong US dollar, which we have at the moment in general, a very strong US dollar, it hurts riskier assets, which is true. Okay. High inflation, he also said, leads to high operation costs, which can inflate profits. What he's saying to that, he's talking about the earnings report, the previous earnings report in quarter 2. Okay, the earnings report in quarter 2 was many ways positive, but like he said this is inflated. He thinks the next earnings will disappoint the market greatly, and this is where we potentially see the real bear market, get involved, the real bear market. And the other thing he has said, which is one of the analysts who, underlines this, and I agree with him. I've said this before in other videos. Don't fight the Fed when the market thinks it can. He does say, the Fed has said in their own words, they're driving us into pain. In other words, they're happy to push us into, or the US and the global, into a very tough situation. They're happy to let the job market. Okay. And here's the thing. This is to answer the question the gentleman asked. The gentleman asked me in the comment section, he asked, how long is the US dollar going to have a break for? And I can't give you exact time frame, but I don't think it's going to be that long. I don't think the bear market or the dollar strength has started, as if dollar strength has finished. So I can't give you a time frame, but I don't. But I tell you why. I think the dollar is still going to be king for a little while yet. I'll tell you several reasons why. For one, okay, like I say, Mike Wilson just said the Fed want to push the US into pain, or happy to push the US into pain to get inflation down. And the problem is, at this very moment in time, the US is not feeling the pain yet. They're not feeling it yet. In fact, there's this old rule. This new rule should be talked about over the last couple of months. Good news is bad news. What do I mean by that? Is that if you have good US data, that actually technically means bad news. Why is it bad news? Because you have good US data, or no signs that the US economy at the moment is not feeling any pain, then that's just going to drive the Fed to be more and more and more aggressive with their interest rate hikes to fight inflation, makes them more determined, which means that the chance of a pivot or chance of them slowing down will become more and more unlikely. So then, yes, the market will still be under a lot of pressure, and you will still see a lot of dollar strength. And I can tell you this now, they're not feeling the pain. Something I mentioned this morning, which again, I mentioned a worrying housing market in the UK. I do think we're going to see a worrying housing market in the US at some point when the pain begins and when the high interest rates begin, because these are really impressive figures. New home sales was released at 0.685 versus 0.5. So 685,000 new homes were sold versus 500,000 new homes expected. That is a very good number. Bear in mind, interest rates are beginning to rise in the US. That's a good number. So again, the market's showing no pain. On the secondly, US durable goods was announced at negative 0.2%, still a negative, versus a negative 0.4% expected. Again, good, reasonable US data. And US consumer confidence was announced at 0.108 versus 104.5, meaning the US consumer still has confidence in the market. Okay. And that's really helped to be open with you with lower oil prices, because obviously they're a lot of they can drive, they have that. So they're not feeling the pinch. Again, they're not feeling the pinch. What does this mean? This means the US or the US Fed will continue to rake interest rate hikes. And at the same as that, comparing the US economy, this is good data, compared to what is happening in the UK, what is happening in Europe, what is happening in some parts of Asia. The US economy is a totally different animal at the moment, which means we are likely to continue to see dollar strength. So it's having a little rest for now. You know, it may last for a couple of sessions. It may just change like that. We never can tell. But in the long term, dollar strength, I can still see remaining and coming back. I really, really do. I really do. Because this is really good data. There's not showing any signs of pain yet. But again, like I say, good news is bad news. This is just going to drive, or the Fed's total commitment to bring inflation down by increasing interest rates. What else is coming up this week? Well, we have German and CPI. Be interesting to see how that is. US GDP. This is another thing. I will be doing a watch along. That's on Thursday. What will that reading tell us? Again, will it be good news, bad news? Will it come in better than expected and then drive the market to be concerned again and more dollar strength? UK GDP, again, that's happening on the Friday, which I'm going to take a key interest in. What's that going to show us? Is that going to put further pressure on the sterling, which is, like I say, for now, having a little respite, keeping hold of its gains it's made so far today, but not dramatic gains, but keeping hold of it. What's that going to tell us? You know, that's a big thing, because bear in mind, we're sort of, you know, the BOE have done a Bank of Japan and said they're watching the situation and they won't hesitate, but they're not doing anything yet. So that's not, this going to help it. So what's the UK GDP going to tell us? And at the same time, you have EU CPI, different pictures. The market, as it currently stands, like I say, it's green Tuesday. It's recovering 0.16%. The FTSE DAX currently trading 0.06% higher, and Eurostoxx 50 currently in the green, 0.33%. So, yeah, recovery Tuesday for now. But like I say, long to medium term, everything points potentially to a more stronger dollar, which, as Mike Wilson said, the dollar is causing real stress already, and the strong dollar is never good for riskier assets, or in general, or the global economy as well. So there we go. Don't forget, you can ask me questions anytime you wish, or have a chat, or share me your opinion. Let me know what you think. Ask me a question about any particular assets at all you want me to have a quick look at. That sort of thing. So bear in mind you've got that, available. Don't forget, like this gentleman did this morning, and I answered it this afternoon. If you think of a question later, okay, you can put it in the comment section, either on Facebook or YouTube. I will see it, and I will reply to it next time I go live on air, which of course will be tomorrow at 8:30 a.m. UTC, and again at 2 p.m. UTC. But as well as that, tomorrow we're doing a next episode of #AskJames. Don't forget, this series is a little bit different. This is more educational driven, not so market driven. These series, we focus on a topic of your choosing. You send in a topic of your choice, what you would like us to cover. And so far, we've done market jargon. We've done an introduction to market jargon, introduction to candlesticks, introduction to trend lines, introduction to fundamental analysis. We've also done introduction to moving averages. And tomorrow's episode is been a request by username Train and Trade, who made a suggestion actually, or did the recommend with the quest in the last episode we did for #AskJames, which was introduction to moving averages. His request was to do an introduction to the relative strength index, the RSI. So we'll be doing that introduction to the RSI tomorrow, and how that can assist, and how you can read that and understand what that is illustrating and showing you, and how that can potentially assist you with some of your trading decisions. So that's going to be tomorrow. That's hashtag Ask James. That's going to be at 12:30 p.m. UTC. So please come and join me for that. Okie doke. If there is no questions, not a problem. Not a problem. I hope to see you sometime tomorrow. Thank you, everyone, for always coming along to watch my little videos. I really do. I really do appreciate it. I really do. But anyway, like I say, till next time, as I always say, if you're watching me on Facebook and you enjoyed this little episode, by all means, give us a follow if you like. If you're watching me on YouTube and you enjoyed this little video, subscribe if you like. Hit the notification button so you know next time when I'm going live. If you enjoyed this little video and you put up with me, my over-the-top enthusiasm for the markets, which I simply can't help because I love the markets, by all means, give me one of those. I see I've got a couple of likes already because I really appreciate knowing that you like what I do. Anyway, till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.